Let's think a little bit harder about whether it was a messy week, whether this is the bottom. Malcolm Ethridge is with us, CIC Wealth Executive Vice President. Malcolm, it's always great to have some time with you. What are you thinking about sentiment right now, and whether these are sort of dead cat bounces or buying the dip with commitment?
Yeah, it's very easy to say that the last week has, sort of given us this reprieve, and folks have what seems like a bit of a short-term memory. But I would cautiously warn people not to get too caught up in the good news of this week, simply because I'm concerned that the Federal Reserve is already sort of tipping its hand, where we had a Fed governor come out this week and take a less hawkish stance than we had been hearing, through the course of this year so far. And that's a little bit concerning, simply because we still aren't there as far as getting inflation back in line, which has frankly been the main culprit of all of this consternation, let's use that word, that we've been seeing in the markets over the last couple of months.
Well, notwithstanding, I mean, Jay Powell has made it clear that another 50 basis points is pretty much in the cards for that June meeting and probably the meeting after that. So even with some of the dovish commentary here, there is a sense that the Fed is going to move towards whatever that sort of mythical neutral rate is, Malcolm. I am curious about inflationary pressures and this sort of sense here. And I think what you're referring to is some of the commentary that we heard out of Raphael Bostic, this idea that maybe some of those inflationary pressures might be able to abate on their own without a more aggressive Fed. Do you think that's possible?
I don't. I think that the Fed actually needs to get even more aggressive than they have foretold with that 50 basis point foreshadowing that you're talking about. I think it's a mistake to tell us that 50 basis points is about as much as they expect. Taking that 75 off the table, or even maybe 100 basis points, taking that off the table, I think has gotten a little bit too far out over its skis, right? Inflation is still in the 8s. We're talking about an inflationary environment where Walmart and Target are coming out and announcing like dismal earnings that are very concerning for anybody who's concerned about Main Street's response to the inflation. And so I just feel like the Fed could be helping us a little bit more in saying we're going to be even more aggressive here. We hear you. We understand that you're hurting. $6 gas in California is definitely a problem. And doing a little bit more about that, rather than saying, job well done. I think we can rest on our laurels here and let you have at it. That's, to me, would be a huge mistake here.
Well, Malcolm, sticking with Walmart and Target, we're finally at the tail ends of earnings season, and we had a kind of mixed front on the retail picture. Obviously, you have your Walmarts, you have your Targets, but then you have Nordstrom's, you have Macy's, and I'm just wondering how you wrap together everything that we've learned really in the past few weeks and what the message is going forward about that consumer.
This week has actually made me start to wonder, if you recall in 2020, back in March of 2020, when the market hit its low and then we bounced off of it, we started hearing and using the phrase the K-shaped recovery, referring to folks, who could stay home and who were hourly wage earners versus salaried wage earners. We started talking about that K in the recovery. And I'm starting to wonder if we're also looking at a K-shaped recession, where now you have hourly wage earners who typically tend to spend a little bit more of the dollars as they come into their hands, versus your salary white collar workers like you're talking about, who can afford to go and shop at a place like a Nordstrom, those higher end shopping places. Or when we look at Gap's earnings, where they broke out that Banana Republic, their higher end brand, was the only one that wasn't in negative territory as far as sales were concerned for the past quarter. That's starting to make me concerned that we're looking at two different recessions, and two different inflations. And that's what is a bit concerning when you look at, again, the likes of a Walmart, of a Target, of a Gap, and so forth.
Once again, inequality, and something that the Federal Reserve has promised to keep an eye on and see how they react to it, though. Malcolm, from your perspective, your reaction function now, I mean, what to do with your money? Staying invested, being in cash? What's the best prospect for you?
Yeah, so if I'm a person who is in a position where I need to put money to work right here, right? Maybe you're a person who rolled over some money from a former retirement account, or maybe you sold a house and you're sitting on a lot of cash and you need to put it to work. I would be looking for high quality companies in any sector, but especially those tech names that are going to lead the market in either direction that it ultimately goes near term. I'd be looking for high quality companies in that space that have already announced plans to return capital to shareholders, whether it's through dividends or share buybacks or some sort of M&A activity or something like that. I want to be invested in high quality companies, not those speculative names that have led us for the last couple of years, but the ones that are showing me that they're committed to putting money back into the hands of their shareholders in the near term.
All right, Malcolm, always wonderful to catch up with you. Have a great weekend. Malcolm Ethridge there of CIC Wealth, helping kick off today's program. And we're going to talk a lot today about the consumer spending. Well, it did rise.